We've talked a lot over the last year about the Great Resignation and how elevated quits rates shows that, hey, it's a workers' market, that they have strong bargaining power and they can quit a job to get a better offer elsewhere. Well, quits rates, guess what? They're still elevated, but they've come down a bit. They've cooled off a little bit over the last few months. You see some of these lines either flat or ticking down. And what's interesting here is that the composition of quitters, of who's quitting, is shifting. We see declines in the quits rates for what I would broadly call hourly or blue-collar workers, so people who work in leisure and hospitality or retail. We see these hourly workers quitting at slightly lower rates, but still elevated over the last few months. And we see an uptick in, so to speak, white-collar quits rates in business and financial services, in manufacturing, or not manufacturing, in finance rather. So we see in several of these industries an uptick in who is quitting in terms of higher educated, higher paid occupations, and a downtick in the composition of hourly workers quitting. So this is shifting. This is maybe a turning point in the labor market. Another sign that the labor market is depressurizing, is cooling off, comes in wage growth. So wage growth throughout 2021 had just been on an upward escalator, just ever higher month to month nominal wage growth. Again, nominal wages meaning not adjusted for inflation. Well, in the last few months, we've started to see perhaps a cooling off of this nominal wage growth, a slight leveling, maybe downtick in both all employees having year-over-year wage gains of 5.2%. But in the red line here, I want to focus specifically on those frontline workers, those rank and file workers, non-supervisory employees who have nominal wage growth at around 6.5%. But again, it's ticked down slightly over the last few months. That's one sign that the labor market is depressurizing. Another sign is just job postings, which are, in this case, data we get from Indeed. Indeed posts at a daily level every week and updates the last 7 days of job postings in different categories. So overall, job postings are still up strongly, 54%. In this light blue here, you see how job postings are up a lot, but they've started to plateau and kind of cool off and decline from their recent highs over the last few months. So earlier in 2022, job postings were higher in several of these sectors, particularly production and manufacturing. So we've seen some real-time indicators that the labor market is, while it's still red hot and it's challenging for recruiters, maybe we're at an inflection point. We're turning the corner. It won't be so high pressure. The cooling of demand will let off some of that elevated labor demand, and we'll be at a more equilibrium point, hopefully, more on the one unemployed person to one job opening level in the next year. If the Fed's goal, if this soft landing that we'll talk about is achieved.